became the bank that broke the world. Our story begins far from the glittering towers of Manhattan, in Montgomery, Alabama, in 1850. Three German Jewish immigrant brothers, Henry, Emanuel, and Mayer Lehman, opened a dry goods store. Their shrewd business acumen quickly propelled them beyond fabrics and threads. They began trading cotton, then other commodities, eventually issuing bonds for the Confederate government during the Civil War. By 1887, the firm had become a member of the New York Stock Exchange, firmly establishing itself as a burgeoning investment bank. For decades, Lehman Brothers navigated the volatile currents of American finance, surviving panics, wars, and the Great Depression, always emerging stronger, more resilient. It transformed from a family partnership into a modern corporation, playing a pivotal role in financing major American industries, from railroads to retail, airlines to technology. The 1980s saw Lehman integrated into American Express, a period of internal strife and cultural clashes, before a dramatic management buyout in 1994 resurrected Lehman Brothers as an independent, publicly traded entity. Under the leadership of CEO Richard Fuld, a man known as the Gorilla for his tenacious, often aggressive style, Lehman embarked on an ambitious strategy of growth. Fuld steered the bank towards a relentless pursuit of profit, significantly expanding its presence in fixed income trading, particularly in mortgage-backed securities and other complex debt instruments. This was a booming sector, promising colossal returns, and Lehman, ever the ambitious outsider, was determined to claim its share, becoming one of Wall Street's most influential and feared players. Its culture was one of fierce loyalty, intense competition, and a belief in its own invincibility. But the seeds of its destruction were already being sown. The early 2000s witnessed an unprecedented housing boom, fueled by historically low interest rates and lax lending standards. Lenders offered subprime mortgages to borrowers with shaky credit, often with adjustable rates that would reset to higher payments after a few years. Investment banks like Lehman packaged these risky loans into complex financial products known as mortgage-backed securities, or MBS, and even more convoluted collateralized debt obligations, CDOs. These products were then stamped with seemingly safe ratings by credit agencies, making them irresistible to investors seeking high yields. Lehman, aggressively chasing market share, became heavily invested in these assets, particularly in commercial real estate and raw land holdings, doubling down on what was increasingly becoming a house of cards. The turning point arrived with chilling clarity in 2007. The housing bubble began to burst. Subprime borrowers, unable to afford their suddenly higher mortgage payments, started defaulting in droves. Foreclosures skyrocketed. The value of the underlying collateral, the homes themselves, plummeted. Suddenly, the highly rated, supposedly safe MBS and CDOs on Lehman's books, and indeed throughout the financial system, began to lose value at an alarming rate. What was once seen as profit now looked like catastrophic loss. The early warning signs were ignored or downplayed. While other banks began to deleverage, reducing their exposure to these toxic assets, Lehman remained committed, perhaps blinded by its own ambition and Fuld's unwavering confidence. They continued to take on more risk, convinced they could weather the storm, even as rivals like Bear Stearns collapsed and were acquired by J.P. Morgan Chase in a government-brokered deal in March 2008. That acquisition sent a clear signal: the government was willing to intervene to prevent systemic collapse. But the rules of engagement were about to change. Throughout the summer of 2008, Lehman's financial health deteriorated rapidly. Its stock price plummeted, rumors swirled, and the bank scrambled desperately to raise capital and find a buyer. Richard Fuld tried to negotiate a deal with the Korean Development Bank, then Bank of America, and finally Barclays. But Lehman's balance sheet was a gaping maw of bad debt, and none of the potential suitors could stomach the risk without substantial government backing. The U.S. Treasury Secretary Hank Paulson and Federal Reserve Chairman Ben Bernanke, having just rescued Bear Stearns and provided a lifeline to Fannie Mae and Freddie Mac, decided a precedent had been set: no more government bailouts for failing investment banks. The moral hazard of continually rescuing irresponsible firms was deemed too high. The fateful weekend of September 13 and 14, 2008, was a blur of frantic negotiations at the Federal Reserve Bank of New York. Bankers from across Wall Street gathered, trying to orchestrate a private sector rescue, but no deal could be struck. The government stood firm. By Sunday night, it was clear Lehman Brothers was on its own. On Monday morning, September 15, 2008, after 158 years of operation, Lehman Brothers filed for Chapter 11 bankruptcy protection. It was, and remains, the largest bankruptcy filing in U.S. history, with over $600 billion in assets. The impact was immediate and devastating. Markets around the world plunged into chaos. The credit markets froze, as banks, unsure of who might be next to fall, stopped lending to each other. Fear gripped the global financial system. The bankruptcy triggered a cascade of failures, almost bringing down insurance giant AIG, which required an unprecedented government bailout to prevent even wider catastrophe. The world economy spiraled into a deep recession, characterized by massive job losses, foreclosures, and a pervasive sense of mistrust in financial institutions. Lehman's collapse forced governments and central banks worldwide to take extraordinary measures, including massive stimulus packages and bank recapitalizations, to prevent a complete systemic meltdown. The fall of Lehman Brothers became a stark symbol of unchecked risk, regulatory failures, and the dangerous interconnectedness of global finance. It forever changed the debate around too big to fail, leading to sweeping reforms like the Dodd-Frank Act in the United States, aimed at preventing a recurrence. While some argue that letting Lehman fail was a necessary, albeit painful, lesson in accountability, others contend that the decision to withhold a bailout, in contrast to subsequent rescues, exacerbated the crisis unnecessarily. What is undeniable is that Lehman's demise etched an indelible scar on the collective memory of the financial world, a potent reminder of the fragility of even the most powerful institutions and the profound consequences when ambition outstrips prudence. The bank that broke the world ultimately broke itself, leaving behind a legacy of profound change and a continuing global conversation about risk, responsibility, and the nature of modern capitalism. If you found this exploration of Lehman Brothers' rise and fall insightful, please give this video a thumbs up. And don't forget to subscribe to our channel for more deep dives into the stories that shaped our world. Your support helps us continue to bring you these documentaries.